Welcome to the weekly Technomental Commodities Hour, Futures Hour, with your co-hosts, Andy Hecht and Mike Martin. Hi, Mike. How are you?
What's cracking, dog?
Good. I'm doing good. So we got some wild volatility in these markets, huh?
Yeah, it's awesome. I mean, it's like we said last time, if someone has a plan, it's really good. If you don't have a plan and you don't know what you're doing, you should sit on the sidelines and let the pros do the work. So you always got to protect your capital.
Absolutely. Look, volatility is an investor's nightmare. It's an experienced, seasoned trader's paradise. But, look, the daily ranges are wider, the opportunities are greater, but the risk is higher. And that's the most important thing to remember, whether you're trading futures or spreads or stocks, whether you're an investor or a trader. Listen, bigger risk means bigger opportunity, but you got to know what you're doing. So let's kind of plow through these markets and see what's going on across the board. Why don't we start with precious metals, and why don't we start with gold today?
Rock and roll.
I'll give you a little back. We had that wild, crazy day last Monday where the Dow Jones Industrial Average opened down 1,100 points, contagion from China, tanking oil price, everything was crazy. And what we've seen on that day is that gold was the one asset that was flight to quality. Gold rallied up to just under 1170. It had been down $100 cheaper. It had broken through key support at 1130, 1135. It had tanked down to 1073 or so, and gold took off in flight to quality buying. We got up to 1173, but later in the week, as markets normalized, gold came back down, and now it's sitting at the pivot point, the key pivot point of 1133 as we speak, as you can see here on this chart. Personally, Mike, I don't particularly love gold here. I think that we're in kind of a global deflationary, maybe recessionary environment, and that's bad for all asset prices. Hey, we're going to have some bounces in these markets, and I think volatility is going to pick up a lot. But gold is not shining like it should be in this environment, and that's particularly the case because of what other precious metals are doing. I'm going to switch quickly to silver here. And silver actually last week on option expiration made a new multi-year low. It traded down below 14 bucks at 13.95 on pretty heavy selling here. Now we've rebounded. A lot of markets have turned around. It's back up to 14.62, but silver, the action in silver hasn't been really good. Let's move on to platinum. Platinum is at $1,010 an ounce this morning. It's down about 10 bucks. It's been flirting with this $1,000 level.
We can't see the chart yet.
Oh, okay. We'll get the chart up there. Should be up there soon. Another interesting thing about platinum here is that platinum usually trades at a premium to gold because it's a rarer metal. It's got a higher production cost. But platinum is actually trading at a discount to gold, which is not the norm, which is a divergence. It's at a $122 discount. Now, if we look back over the last 40 years, platinum traded at a discount, the worst case discount of 200 bucks. That was in 2011, 2012. It traded at a premium to gold in 2008 of 1,200 bucks. So it's an anomaly that it's at a discount to gold because of the various characteristics of platinum. And therefore, I think it's another kind of nail in gold's coffin here. Platinum and silver are telling us that gold is too strong. On the other side, gold is strong because people are buying it because they're scared about things, but it is not moving up, and that concerns me a bit about the price of gold. One other precious metal here to look at quickly is palladium. Palladium did what a lot of other markets did last week. It went down sharp. Because as it's an industrial metal, it got down to 520 an ounce, but now we're back at 600 an ounce. So as you can see, Mike, volatility is picking up across the board, and this precious metal sector is no exception. So let's move on and let's look at the most important base metal. The most important base metal is, of course, copper. Dr. Copper, or the barometer for global economic health, the barometer for China. Copper price told us that China was in trouble long before China did, or long before the other markets did. So it's an important commodity to watch. And as you can see on the copper chart, if you have it up there, it got down last Monday when everything was in tanking mode to 220 and a quarter a pound, which is the lowest price, a fresh 6-year low. Now, along with everything else last week, it bounced up. Now we're at 233.75. And look, copper is a fickle commodity. It could certainly continue to bounce. When we get to oil, we'll see what real bounce looks like. It's an industrial commodity. You know, it's got some things going on. Let me see if I can get some volume and open interest there. One thing, when you see it on the chart, you'll notice is that open interest in copper has absolutely dosed. The open interest is the number of open, long, and short positions. It represents speculative interest, really. It's kind of an indicator of speculative interest. On August 13th, we were up around 200,000 contracts, open interest. In a very short period of time, we've dropped to under 160,000 contracts. And that's telling us that the shorts, a lot of shorts covered because the price came down, and now we're just sitting here. I believe copper is going to go to $2 because I think the problems in China are real. You know, the copper price in 2008, when the you-know-what hit the fan and the global financial crisis and the housing crisis in the U.S., copper went to $1.25 a pound, just under there. In 2000, copper was 85 cents a pound. Now at 233 a pound, you know, a lot of people are saying, hey, it was 465 in 2011. It's almost half the price. It is actually half the price it was then. But there is some downside room in copper, and copper, you know, is going to reflect China. So that's important. You have anything to add on any of these metals before we move on and we talk about the stuff that we eat?
I just say that this thing starts trading down again. This copper is a good short entry here, lower risk. You know, you're at the top of the range. And two, if the bad news keeps coming out of China, you know, those shorts will re-enter the market and they will enter it very, very quickly. So you'll see this thing go parabolic down in no time.
Oh, I agree with that 100%. So let's switch our attention now, and let's talk about the grain markets because, hey, it's August 31st. Tomorrow is September. When you think September, you think back to school. When you think back to school, you think the fall. And when you think the fall, if you're a farmer, you think harvest season. And it is harvest season. And it appears from grain prices that the crops are going to be pretty damn good this year. We're going to have some good prices are certainly reflecting the fact that crops are in good shape. And the USDA WASDE report, the World Agricultural Supply and Demand report that came out in August, was very bearish for grain prices, but it was very bullish because it was very bullish for yield. There's going to be a lot of soybeans and a lot of corn out there this year in the U.S., and as you know, Mike, the U.S. is the largest producer and exporter of corn and soybeans in the world. So when we look at what's going on in the world of soybeans, we're at $8.8225 per bushel on the new crop, November soybeans, and that is close to lows. Listen, we got up to 10.45 back in July when there was some worries about soybean tightness, but those have dissipated. You know, when it comes to soybeans, I think we're closer to the lows than we are to the highs. We're closer to the lows than we are to the highs, certainly, and we have to be very careful. One of the things to watch in soybeans is the crush spread. You know, that's where they take soybeans and they make the products we buy, the soybean meal, the soybean oil, the consumer products. And that soybean crush is up at $12.76.
Can we put that up?
I can't put that up, unfortunately. I don't have a – let me take a look. Let me see if I can put that up here. PCX. Give me a second on the November contract. There it is. You should see it in a minute. The metrics at the bottom don't really matter. It's just the nominal price of it. At $12.52, 76 cents rather, for that synthetic soybean crush, and that basically represents turning soybeans into soybean meal and soybean oil. That's kind of a high price for it. It's actually the highest in November. We were down at $9 a few months ago. The chart doesn't go out that far because I'm just looking at the new crop contract. But if I put up a continuous chart on that, which I will try to do, you'll see that, we're kind of at decent levels, higher levels, and that is indicating that there is some demand here for soybean products. And it's classic economics, Mike, because as the price comes down, for the beans, it sparks more demand. Classic economic theory. Now I have this weekly chart up here, and you could see that back in April we were down at 660 on this soybean crush. Now we're up. Well, this is a chart. The continuous shows the active month, and the really active month here is the October. So it doesn't show what's going on in the November. It shows 1142, but the new crop is at 1276, even stronger. So we're seeing some demand here, and that's one of the reasons that I believe that we could, the downside is limited in the beans from here. Hey, don't forget, beans were 18 bucks a bushel a couple of years ago, almost 18 bucks. So $8.81, $8.82, it's kind of cheap. Let's move on and look at corn here, another one of these big crops that's important this year. We got the corn price here at $3.73 today. We had a big spike down on Monday in this global economic meltdown, this 1 hour meltdown. But I kind of like the action in corn on Monday, last Monday. Got up to 365 and closed all the way up at 380. We're coming off since then a bit, as probably crop conditions are improving a little bit. But one thing to keep in mind about corn, and the reason why I like corn better than all the other grains here, is I think that the USDA looked at the corn crop with rose-colored glasses. I think that they overestimated how great this crop is going to be. We're coming off 2 years of incredibly bumper crops. And I think that the crop will be good this year, but maybe not as good as the USDA thought. And that gives us some upside. So I think corn at 373 is cheap. I don't think it's going much more than here. I think all the bad news is in the price. And I think it's a low risk, medium reward long here on dips, only on dips. So let's move on and look at the wheat price. Wheat is down at 480. Longer term support in wheat is around 460. Wheat is not a primary crop of the United States, whereas we're the largest producer of corn and soybeans. We're in the pack. We're the largest exporter of wheat, but we're only in the pack in terms of production in the world. Australia, Canada, the Ukraine, Russia, all wheat producing countries, and as such, global weather affects wheat. Now, we're going to have, we have the strongest El Nino weather pattern this year since 1997. And that means that a lot of times El Nino screws with weather patterns around the globe. That means, in some places you're going to have droughts, in some places you're going to have torrential rains, you're going to have extremes. And that's not good. Extremes are not good for agricultural crops. And that means that wheat could come into play later this year. So I kind of like the risk reward in wheat here for a medium to longer term trade, maybe some call options in the wheat out to next March or something like that. I'm keeping my eyes on that, and I'm a buyer of wheat on dips. Wheat is a very volatile commodity because of its ubiquitous production nature. Anything to add over there on the wheat or the corn or the beans?
Yeah, I mean, with the beans specifically, I would look at spreads, either with options or with the old crop, new crop kind of stuff. Some calendar spreads. That really isn't my trade. In terms of wheat, right here, all the guys who are trading like CTA-based models, systematic models, they'll be entering the markets here because every day is a new low. But it's not my trade, so if anything, I'd be short, but basically I'm sitting on my hands on the wheat right now. I'd be looking more for spread, stuff that I could take home over longer periods of time. That's all.
Every day's a new low, and every day's a new adventure in these commodity markets, and all the futures markets. Wouldn't you agree?
Yeah, I mean, you have to You have to know what your trade is and then stick to it. So you're looking at lumber right here, and it's Monday, so lumber trades.
Exactly.
Lumber's
Exactly. I'm looking at lumber because,
I mean,
to
that's
me, Mike, lumber is the third leg of the stool in the commodities that give us real insight into the global economic condition. Copper, lumber, crude oil. That's the legs of the stool. That's how I look at it. And what I've seen in lumber is like what I've seen in copper. And we're seeing something different in crude oil today, and we'll get to that in a minute. But if you notice, lumber back in June traded up to $300 per 1,000-foot board. Lumber is now lumbering down at 237, just above the 234.60 support from May. Filled a gap on the charts here. I mean, this thing gaps all over the place. Look, lumber is tough. It only trades 4,876 contracts today. It's got less than 7,000 contracts of open interest. So I wouldn't suggest anyone get involved in the lumber market. But you got to look at the lumber market for clues. You know, sometimes you don't have to trade a market, but it's very useful to look at for clues. And lumber is an important market to see. And that's telling us some shaky things about the housing market here in the U.S. It's telling us some shaky things about the global infrastructure building, certainly reflecting what's going on in China. That's why I put the lumber chart up there. Just so we can lumber.
Do me a favor, take your mouse and look at like those last red bars. Look at the big leg down, coming down when it took out, 28. Just look at what was the volume that day. Can you see that by
the volume? Yes, absolutely. That was July 13th, and let's see what the volume was on July 13th. It was 2,167 contracts. Okay, so which is fairly low.
Yeah, I mean, so there's traders in crude oil that might do a 5,000 lot in crude just as one trade to give you an idea. And so when I look at the CTAs who call me and say, I have the systemized thing and blah, 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 and I include lumber, and I always wonder, like, wow, there's no thought being in, put in that, because this is not something that you'd want to trade in futures. It's susceptible to limit move. You can be locked out. This is a market where you'd want to be synthetically long or short via the options market if you had to be in it at all. But this is not something that you'd want to be in trading outrights, and if so, you'd maybe be looking at ones or twos. This is not a market where the reward is equal to the risk. Even when you look at expected values, I think it's more trouble. If you go back to 2013, you could look at some of those monster down days. Sorry about that. But this is where you might trade option spreads like bear put spreads or bull call spreads, for example. You start selling options to underwrite the cost of getting long on the call side, and you use puts to help offset the cost of buying, and then buy them with some time on your hands, so that this way you can let the markets unfold and let all the guys who are greedy or trying to be cute or smart mess around with the futures, and you just sit in the options. You can take it home over the weekend. Limit moves won't kill you, because if you have a debit bounce, you know what your max loss is. So that's my 2 cents on lumber, the lumbering lumber market. That was very good. Andrew.
Absolutely. And you know what? I couldn't agree more. And I've been trading, Mike, since 1981. I have never traded a one lot in lumber. However, every single day I look at this market because it gives me a sense of what's going on. As I said, it's an informational market. It's part of the stool. It's part of the copper, oil, lumber, international kind of real-time indicator of the global economy. So it's important from an informational standpoint for me. But I agree, trading lumber, it could be a nightmare. What we used to call commodities like lumber are roach motels. You can get in, but you can't get out. So let's move on now. Let's move on now, and let's look at crude oil. And boy, is that a move. I have to tell you, first thing I want to do is I want to put up a weekly chart, because I want to show the listeners a pattern here that developed last Friday. Crude oil, listen, the fundamentals haven't changed in the last couple of days, even though we've gone from 37.75 last Monday, which was a new multi-year low, up to $48 as I look at the screen here. The bottom line here is that there's a lot of production around, but there's a lot of nervousness in crude oil. And if you look on the weekly chart, Mike, last week was a very important technical signal, a bullish key reversal to the upside. We saw a new low last Monday at 37.75. We closed over the previous week's highs, and today we're getting some really nice follow through here, and on weekly charts this is turning up. Now let's not forget, in terms of oil, when we made lows back in March, we made some aggressive lows back in March at 42 bucks. We had come down. Well, if I had the continuous chart, I let me put the weekly up again so we can see what I'm talking about here. Back in March, we got down to 42.03, and people were calling for $30 oil, $20 oil, $10. I heard someone on CNBC said that crude oil is going to be like whale oil. It's going to be 10 or 8 bucks a barrel. Well, crude oil then proceeded to rally 9 weeks straight, and it rallied 49%. Okay? We're seeing a similar thing go on here, only kind of more aggressively. We had that horrible day, back to the daily chart, last Monday, where we got down to 37.75, a new low, new 6-year low, I think, something like that. And then we kind of flatlined around that level for 2 days. And then we took off last Thursday. Friday we added to gains. Today we're adding to gains again. Now, as I said, the fundamentals haven't changed. The U.S. is still producing over 9 million barrels a day. Russia's still spitting out over 10 million barrels a day. But the problem here is a couple of things, and it's all in the Middle East. First of all, OPEC. There's a lot of problems between OPEC members. Some of them want cut production. OPEC's producing 31.5 million barrels a day, probably go to 32 million barrels a day once the Iranians come back online after sanctions are lifted, which looks like it's going to happen. So the bottom line here in oil is there's still a lot of oil around, but there's in the cartel, in OPEC, there's some pressure to cut production. That's number one. Number two, there is a proxy war going on between the Saudis and the Iranians in Yemen, and Yemen shares two things: a very long border with Saudi Arabia. So if it spills over, it could affect some oil production. And remember, Saudi Arabia is the 800-pound gorilla in the oil production market. It also could cause some problems for some logistical shipping routes in the Persian Gulf and the Red Sea. Could be some problems there because of this violence. Crude oil will react to international politics, and I think what we're getting back here is a little political premium on crude. So we're at, over 48 bucks, and if I do a quick calculation here, if you will allow me, we have rallied since the lows last Monday an incredible 27.5% in crude oil. That is quite a move. Open interest has stayed the same. The technicals on the daily chart, of course, have turned higher with price. I think we're going to run into some problems around the $50 level. There's no problem. There's no question about that, because eventually fundamentals come back in. But hey, crude oil got a little too cheap, got pushed down a little bit, and this is helpful for the U.S. equity markets in the long run, because so many of the stocks in the indices are oil-based companies.
Looking at the open interest, though, you got to figure out, was this really this big spike here? I hate V-bottoms, by the way. Was it shorts just covering? Because it doesn't look as if it looks to me as open interest has gone down. So that to
open
me
interest has marginally, though. When we were at the lows, open interest has gone down while we were going down. So I think shorts were taking their profits at new lows. But since we made the low on the 24th, open interest was 1.67 million contracts. We're actually up now. We're at 1.68 million. So I'm not seeing anything in open interest that's telling me, that's glaring, that's staring me in the face.
So let's help the folks that are students, though, right? So if you see that it's flatlining, it could mean that there's just churn, right? So the shorts are covering and new longs are entering, so hence you have a no change in open interest. What's your 2 cents?
Absolutely, but what I like to look for in terms of looking for real opportunity are big changes in open interest, and maybe we'll see that in some of the other commodities that we go through after we talk about oil. That tells me that, hey, big capital shifts have happened in the market. So I'm looking at open interest here as a very neutral factor. I thought oil was getting too cheap below $40. It's a political commodity. I'm kind of more looking at the global macro in terms of oil. I think we've had a great run up from the lows last week, and I think we're going to run into some real resistance around the 50 mark. If I was long oil here from last week, I'd be taking my profits, that's for sure. So let's take a look at oil products, because remember when we talked about soybeans, we said that consumers don't buy raw soybeans. They buy things like soybean meal and soybean oil. Well, in oil, the consumers don't buy raw oil. They buy gasoline, heating oil, jet fuel, naphtha, all of the oil products. So let's take a look at what happened in gasoline. It tracked oil very well. We have to realize that now, end of August, end of driving season, gasoline demand is going to go down. Kids go back to school. Vacation season is over in the U.S., and we're going to have less demand. But it's followed nicely. Crack spread in so we're up to almost $1.50 a gallon, which is not a surprise. Now we saw a big dip here in open interest. We've gone from 393,000 contracts in gasoline down to 363 contracts, which means that shorts have covered in gasoline, or some longs who bought have taken this rally opportunity to get out. Looking at the refining spread for oil, for gasoline, we see something totally different. We have dropped like a stone. In the middle of August, we were up over $20. Now we're down at $13. Now I write that off to a seasonal effect in the gasoline. Let's look at another oil product here, heating oil, because when refineries stop making as much gasoline, they switch to heating oil, which, by the way, is really a year-round fuel, because heating oil is a great proxy for diesel, and diesel is what drives the trucks around the country to deliver goods to market and so on and so forth. So we had a nice rally in heating oil along with the crude oil from about $1.39 a gallon wholesale all the way up to $1.68 a gallon wholesale. And a quick look at the crack spread, or the refining margin, for the heating oil shows something different. We've actually gone from under $20 up to $22, showing some strength. And I would say that strength is seasonal strength in the heating oil. So the refined products are not telling us too much about crude. Crude is kind of in a runaway market now, recovering, and the prospects look good technically, but fundamentally, there's two things. Fundamentally, it's very balanced for crude oil. You got the Middle East, which is always a nightmare position. You know, I sat on a trading desk in 1990 at Fibro, traded with Andy Hall, and I watched the price of crude oil go in one August night from $20 to $40 a barrel on zero trades. And that was because Saddam Hussein walked from Iraq into Kuwait. The Middle East now is even more turbulent than it was back then, and therefore, as the most political commodity in the world, with more than half the world's reserves in the Middle East, crude oil is always potentially ready for an explosion to the upside. So we have to be very cautious if we short this market. If you are looking to take advantage of this rally and you believe that the fundamentals weigh on crude oil, you're much better off using this rally to buy some puts, maybe the 45 to 42 strikes, short term for the downside. But I think crude oil is going to get back to $50, and it's going to sit around there for a while and take a little pressure off OPEC, and then we'll see. But one thing, if we step back a couple of steps, we know is, hey, since last June, oil is doing nothing other than making lower highs and lower lows. And that's not a very bullish technical pattern for a long-term trade.
Hey everybody, this is Michael Martin here. Andy's an amazing teacher as well as market commentator, and he has an amazing course on commodity spreads and market structure. He's going to be doing a webinar on spreads in the next couple of days. So go over to martinchronicle.com/Andy with a capital A and get your invite to the webinar. Seating's limited because the technology is, you can only have so many people on there. Plus, we like to answer the questions. You have 1,000 people. You can't get to everybody, then they feel frustrated. So go to martinchronicle.com/Andy with a capital A. You see it right there. and we'll send you a webinar invite. See you there. It's going to be really good.
So let's move on here. Do you have anything to add on crude or oil products?
Nope, I would just say if you're not in the trade already, this is the one where you could be susceptible to chase, and chasing doesn't work because sooner or later the dog chases the car comes to a halting stop, the dog runs headfirst into the back of the car. Don't do it.
I agree with you. One thing I'll add, oil spreads like the DCDs, the December 2016 versus December 2015 oil spread here. Let's just take a quick look at where that is trading because the contango or backwardation will tell us a lot. Last week we were about 15% contango, and today we should be lower. Yes, we're at 10% contango, which is just reflecting the higher oil price. I don't think oil's going back into backwardation anytime soon because there is just too much oil around. But the contango, the difference between the nearby month and the deferred month, the fact that the deferred month is trading at a premium, that's what I mean by contango, has narrowed, and that is in response to the higher price. Let's move on. Let's look at natural gas. All right, this is a commodity that I am loving. This is a contrarian play here. There are a number of reasons that I love natural gas here. First of all, it has been in a range between $2.60 per million BTUs and roughly $3 for months now. We're coming out of the summer. Today's the last day of August. Tomorrow's the first day of September. In the last 12 out of 15 years, we have had natural gas make lows in August and move higher in September and October. And I am a strong believer that history loves to repeat itself. We're coming into a time of the year where natural gas demand is naturally going to rise because winter is on the horizon and people need to heat their homes. That's number one. Below $3, it is historically cheap. Over the last, since the natural gas futures contract was released, was inaugurated back in the late 80s, early 90s, the range in price has been about $1 per million BTUs to about $15 per million BTUs. We're at $267.50 right now. It is cheap on a historical basis. Now there's new demand areas for natural gas. One, the administration has said coal is dead, long live natural gas. Coal-fired cogeneration plants that make electricity are now going to switch to natural gas. More demand for gas. Also, the liquefaction of natural gas to ship it to other markets, such as Asian markets, where the prices are much higher because they don't have the reserves, is a bullish demand area for natural gas. I really like natural gas here. I really like the futures. I like the ETFs. There's a lot of ways to play natural gas here. I think we're going to see natural gas over the $3 range. And if we look all the way back to last December, we can see a gap on the chart here between 331.20 and 336.70 on the October futures chart. And those gaps, as you know, Mike, they love to get filled. We also have stochastics, momentum in oversold territory. Relative strength is kind of neutral. And we have declining open interest, which tells me that no one cares about this market. And I love to come after a market when no one cares about it.
Hey, let me tell you something. I have that sugar trade that's part of my coaching program. It's a position trade. I held it for 7 months, and I took it from 9 all the way to 18. And it went berserk back in 06. Do me a favor while we're here. Would you please put up a spread trade, the March-April of natural gas for 2016?
Let's take a look. NGH6 minus NG, March-April?
Yep.
March-April, NGJ6. Let's take a look. I'm taking the, let's see where that, there you go. It's at, let me just see exactly where this is. March-April is at around 14 cents. This is the Widowmaker.
Yeah, this is my kind of chart for everybody who's interested in stuff. Again, when you look at spreads, you can look at the outright markets and see that the charts are a bloody mess, really mess. There's no trade whatsoever. Like, for example, in soybeans, there's no trade there whatsoever. So when you're looking at the Widowmaker year over year, and Andrew can highlight that, there are seasonal tendencies, right? As you go from needing electricity to power to heat, and the natural gas widowmaker spread, March, April. Octis is another one. This is a spread that you want to see, widen or narrow over that period of time, and you can see the history of that. And don't forget, when you trade spreads, you're hedged, right? Because you're long and short, two highly correlated instruments, right? So you're trading, you're not bullish or bearish. You're just playing the difference. In some commodities where there's carry charges, you're playing to either capture that or not. So look at the spreads, because they tell you a lot about how the individual markets will go themselves, because they reflect the overall thinking from the people who actually use the commodity.
Let's take a quick look. Let's switch to the soft or the luxury commodities. Let's take a look at sugar, a commodity that's been decimated. In 2011, we were at 36 cents a pound. Today, we are at 10.7 cents per pound. So we are less than one-third the price in sugar. Every rally in sugar has been a sale. We tried to have a rally last week. We got up to 11.1 cents, and we're selling off today. So a continuation of lower highs and lower lows in sugar. It's kind of like a ski slope here. It just goes down and flattens and goes down and flattens. But we're getting down to levels in sugar where it's getting interesting for me. We have seen open interest decrease in sugar from 856,000 contracts on August 21st down to 800,000. So that's a pretty interesting decline. So it's telling me that people are not that interested in sugar right now. But the El Nino weather pattern can cause lots of problems in countries where they produce unsubsidized sugar. And what I'm talking about in terms of those countries is Brazil, the largest producer of sugar in the world, in Thailand, in India, where weather can really screw around with the crops. So the lower this goes, the more I think we could have an opportunity here. Let's shift and take a look at coffee here, because coffee is a market that I like here. I think coffee's been really oversold. It's a very volatile commodity. It's at about $1.24 a pound or something. We were up at over $2 back a couple of months ago. This thing goes up and down like you can't believe. Volatility is very high historically in coffee. As you can see here, we're at 34% volatility, but I've seen coffee traded 100, 120% volatility. A couple of reasons I like coffee. The 2014-2015 deficit in the market is about 6.9 million bags. A report from Rabobank came out, said that the deficit for 2015-2016 is going to be 1.9 million bags. So we have a deficit condition. Everyone drinks coffee. That's not just me. That's all of us, around the world. We drink it in the morning. We take coffee breaks during the day. After dinner, we go out for a nice meal. A lot of us have a cup of coffee. There's a lot of coffee consumption. And the elasticity of the coffee price is not that strong. If the coffee price doubles, people are going to still drink coffee. So we've seen it trading. It likes to trade between $1 and $2, and it trades all over. So we're close to where the support is in coffee. Again, it's another commodity where El Nino can come into play. I like coffee here. I like longer-term call options, maybe out to March 2016. Coffee trades on the ICE Futures Exchange. Definitely interesting to take a look at those Arabica coffee futures. Liquidity is always a problem in coffee because it moves really quickly, but it is definitely a very interesting and volatile commodity.
That's
again, oversold here.
That's your broker calling with the fills on those coffee calls.
That's right. All right. So now we're going to switch over to cocoa. Cocoa has been in a long-term bull market. Cocoa has it's a demand-based bull market because the growth of demand for chocolate confectionery products in Asia has been increasing. The Chinese have discovered chocolate, and once you discover chocolate, you never turn back. I mean, I'm a chocoholic. I love this stuff. We saw last week a nice spike down to below 3,000 on Crazy Monday, which was an outlier day where everything was hitting the skids. Every asset except for gold went down pretty much. It was flight to quality, so it was a risk-off day. People took positions off. But we came back nicely, and now we're around 3,100. Resistance here is up around 3,400. The all-time highs from 2011, 38.26. There's some supply problems in Ghana. Ghana's crop is about 22% below where it was last year at this time. And when it comes to cocoa, the 65% of the world's production come out of the Ivory Coast and Ghana. And these countries are right next to each other. If Ghana's crop is lower, you can be sure that perhaps there's problems in the Ivory Coast too. So I like this commodity on dips.
Let me,
Go ahead.
I've traded a lot of cocoa in my day as I focused a lot on the softs. And like Andrew said, you know, the Ivory Coast and the west coast of Africa is kind of like the Middle East for softs, right? It's a very politically unrestful kind of place. Cocoa does not have limit moves. The other thing you need to know about the cocoa market from a fundamental standpoint is that it's not like say you're in Kansas, right? A good buddy of mine, John, lives in Kansas. And you go out and you talk to the farmers, and one year they're growing sorghum, the next year they're growing flax. They do crop rotation, in other words. And like Andrew said, I think last week, farmers are, their land is their asset, so they're trying to create yield by growing crops. And they're going to try to grow the crops where the highest prices are, because they can kind of know what their production costs are going to be, from the cost of fuel to the loans on the hardware that they're using, the tractors and stuff, to the labor, to the water costs, to the fertilizer costs. And then, of course, they know the crop year, which is set by Mother Nature. In cocoa, though, Ghana just came out this morning and said we're going to correct, right? So we're down 22. That next year's yield is going to be up 20%. So you can't really believe anything that these people do because they're talking their book. If that's going to put pressure on prices, you have to understand, though, that cocoa isn't something like you can plant in the Midwest. And for example, the cocoa tree, right, that produces the pods, once you plant one of those trees, it takes approximately 7 years for it to get to a maturity where it can actually produce yieldable, that's a new word, produce a significant amount of yield of cocoa to make it financially worthwhile. So they can't just turn on a dime. In fact, if there's a fungus or a fire, or who knows, some kooks go through with a machete and chop the trees down, it's going to take a long time to bring the supply back up. So anyway, just my 2 cents on cocoa.
No, great. That's a great little education on fundamentals. And, there was a guy, I forget his name, that used to go out to the Ivory Coast and Ghana every year and count the pods. And companies like Hershey, Nestle, Cadbury's, they would pay him a lot of money to do this fundamental research. I know he was good friends with my ex-colleague, Tony Ward. I think his name was Hans Killian. He retired recently, but he was the foremost expert. And Mike is dead right. The fact that this commodity is produced in countries like the Ivory Coast and Ghana means these are not the most politically stable countries in the world. And a vast majority of people in these countries are employed in some fashion in the cocoa industry, whether they're in the fields picking the beans, whether they're processing the beans, whether they're bringing the beans to market from the trees over to the ports. They're involved in these markets. And you can have a great cocoa crop in the Ivory Coast and Ghana, but if you have problems with the roads, with the logistics of getting it to port, these cocoa beans in that hot African sun can roast and can deteriorate very fast. So it's not just the crop. There's a lot of other things that go into cocoa, which make it a very volatile market.
Yep, it's not the other guy who was a pro, and they actually worked together, was the founder of Commodities Corporation, Helmut Weimar, who I know pretty well. And he and Hans Killian, they used to go on a Range Rover and he would actually count the trees and count the pods to get a good forecast. Mind you, Weimar got a PhD from MIT, and I actually went to MIT Press and bought his thesis for $50 or whatever it was. And his whole thesis was dynamics of the world cocoa market. So between the two of them, they would certainly give your boy Andrew Ward a run for his money in terms of being chocolate finger. But these are very tough markets to trade, so be careful. Right,
exactly. Just be careful, have your stops, or use options, and, You got to be careful, especially now that volatility is so high in every asset class. I don't care if you're trading commodities, stocks, doesn't matter. You got to be careful out there. Anyway, let's turn and let's talk a little bit about cotton quickly. Cotton price, another victim last week. As you can see, cotton just dosed. It got up to around 67 cents, came all the way down on Monday to around just below 64, and we followed through. We got down to 62 and a quarter. Today we're at 63 and a quarter. You know, the USDA and the WASDE in August came out and said, hey, you know, there's not as many cotton inventories as analysts think. And by the way, we didn't plant this much cotton this year in the U.S. because there's so much in inventory. So cotton exploded higher, as you can see here. Now we're kind of coming back down, but we haven't come back down to the lows. I kind of like cotton here. Look, the price was $2.27 back in 2011. We're down at 63 cents, so we are very cheap on a historical basis. And, you know, I kind of made nice lower highs and lower lows all year. Recently, we kind of made a new low. We made a new low last Monday, on August 12th, rather, and then we exploded up in a bullish key reversal. We followed through, and then we've come down again, but we haven't gone to those lows. This kind of tells me, Mike, this chart, what oil might look like. We might follow through, get up to the 50 level, and then come all the way back down to like 40 again. Kind of might be a portend what the future looks like. Anyway, that's for oil. Let's take a quick look at the last soft commodity, another very thinly traded one, frozen concentrated orange juice. Today we're at $1.29 a pound. A couple of things going on there. Demand for orange juice is down because of competition from other fruit juices and from power drinks. A volatile commodity, but another one, like lumber. I don't think you want to trade it. 1,400, and I have traded this one, and it's a roach tell at best. 1,490 contracts traded today. That's about average in orange juice. On a big day, we see 3,000 contracts. Only 12,642 contracts of open interest. So if you have a big position in this, the market tends to run you in. Now, there's been a nice recovery here. In risk-off scenario, we came down last Monday with the rest of all assets. We've rallied back to where we started from. We're going to come into winter, and there's always the worries about freezes in the orange groves in Florida if the weather gets a little too cold. But right now, 130 is kind of like the pivot point here. I do think, though, I mean, if gun to my head, I would be short orange juice here with a stop above 135, looking for the 110 level because of the fact that the fundamental demand is so much lower because of the competition from other fruit juices.
Here's the thing, though. Here's the thing with OJ is that, you know, we're not even into the fall yet. And, you know, there's always that 1 week where a big freeze comes through and checks out the crop and the thing goes, you know, it spikes. So for those of you that want to take a look at OJ, you know, put this on the back burner and watch it and look for a pattern like this, because I think if you clear 135, you know, basis to November, you got a lot of clear blue sky up there that could take you up to 150. So what I like to do is, you know, buy a longer dated out of the money call here and just take a look at the contracts that expire towards the spring, because if you get a late freeze like in March, it kills the crop, it freezes the fruit and renders it useless. It's all spoiled. So there's always panics in those markets. It's kind of tough to trade, but that's why you do those binary types of trades with options, and if you can do them, you know, cheaply.
Absolutely. But another thing to be careful about is that because of greening, citrus greening, Florida has become less important in oranges. And actually, the largest producer of oranges in the world is Brazil. And so although Mike's right, if we get a freeze, certainly in Florida in late March, the price will go up, but not as dramatically as it has in the past, because much more supplies today of oranges do come to the U.S. and around the world from Brazil rather than Florida as they have in the past. So anyway, we've gone through, let's see, we've looked at metals, Mike, at agricultural commodities, at energy, at soft commodities. Let's take a look at what's happening in the meat markets. and we'll put up the chart of the October cattle. If we can get it, let's see. This is, let's see, I got a GLE. There we go. And cattle prices kind of stable, $1.43.20 a pound. We're at the end of grilling season. Actually, this next Monday, end of grilling season, meaning that, you know, those barbecues in a lot of places around the United States can get packed up for next year. And that means that traditionally the demand for meats, for steaks, burgers, pork chops, pork loin, ribs, hot dogs goes down. And that has a seasonal tendency in the meat markets. But cattle has been strong. I mean, for years, around $1 a pound, 80 cents to $1 a pound for the live cattle contract. Now we're up at $1.43, and that's because, you know, increasing demand from Asia. Demographics, if you listen to my course, the first session is all about demographics, and you know, I urge you to check it out because demographics play a lot into all of these commodity prices, because commodities, folks, are finite assets, and as population grows, there's more competition for these finite assets. And when it comes to beef or cattle, more people are eating beef around the world because simply there's more people, and wealth is growing in China, and the demand for a more complex protein diet has grown. So cattle prices kind of quiet here. I don't see anything special. I mean, it's crossed to the upside in terms of momentum on the stochastic. RSI is kind of neutral here. Open interest is down pretty dramatically from the beginning of the summer, and that's no surprise. That is really a function of seasonality in this market. So 143.375, nothing special about the cattle price. The feeder cattle, now the live cattle has a physical delivery mechanism. The feeder cattle contract does not, and it's much thinner. As you can see here, today's a very quiet day in cattle. We've traded 28,000 contracts, so there is some liquidity. If we look at feeder cattle, which is a cash-settled contract, we have traded under 2,000 contracts today, and that's at about $1.97 and change a pound. So I like to use the feeder cattle contract to see if there's divergence between feeder cattle and live cattle prices. I mean, feeder cattle traded a nice premium to the live cattle because of the makeup of the contracts, but I like to look and see where they diverge. Turning to the last commodity we have to cover today before final comments, lean hogs, and lean hogs are up almost 2 cents today, 0.15. In our last broadcast, I talked a little bit about the consumer choice spread, which is the hogs versus cattle, the pork versus beef. And right now, at current prices, it takes 2.1 pounds of pork to buy 1 pound of beef. And over long history, this spread usually average trades at around 1.4 pounds of pork in each pound of beef. So we're seeing a divergence. Pork is either too cheap or cattle is too expensive on a historical basis. I still like this spread. I had put it on at around 230, 240. I've taken it off. I'll look to put it on again if it trades higher. I think the trend in this spread over years is higher because more beef consumption. But hog prices have come down from $1.30 last year down to 68 cents. There's lots of population of pigs around. So, you know, you keep your eyes on that spread. That's an interesting inter-commodity spread.
Let me tell you something right now. This hog trade right here is one where you'd want to be long, right? You had the big rebound where it was up a couple of limits. Then it had every opportunity to sell back off and go back to the 62.50 range. It kind of consolidated up there above that big range day, that limit up close. It didn't quite take out. It failed the first time, and now it's gone up there on, you know, we'll have to see what kind of size. The thing to worry about right here, if you're looking at that 67.50 range, if that's what that number is, I can't see it because it's blocked out by the 68.10, is if this fails or if this move doesn't happen on above average volume, then you definitely want to be very protective of your capital and put a tighter stop in. But this is a very bullish move right here.
So that basically wraps up the show for today, the technical Commodity and Futures Hour. We're on each week, and I guess my parting comments to everyone, folks, thanks for listening. And you got to be careful out there. There's a lot of volatility in markets here. Trade with tight stops. Look for opportunities. These big volatile markets mean that there are a lot of opportunities and divergences out there. So look for those divergences, trade with stops, be careful. When you can, use options, because when you buy an option, all you can lose is the premium that you pay.
This has been the Weekly Commodities Show with Andy Hecht and me, Michael Martin. It's brought to you by martinchronicle.com. Please subscribe to the channel and get alerted first when we post our next show. Have a great week.